Welcome to SB Talks. Today is Wednesday, November 8th, and I'm joined by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, Nick, only one place to start today, and that is at home. Yesterday, Michelle Bullock possibly faced down some political pressure and some commentary to hold steady on rates, and despite saying that she feels that we're past peak inflation, the RBA have made the move, raised rates by 25 basis points, and now we're at 4.35%. What's your take?
Yeah, I think we had penciled in that there was a possibility that there would be another rate hike either in November and or December, depending on the third quarter inflation data, which we got at the end of October. And that data really pointed to it taking longer for inflation to get back into the top end of the RBA's target range, that there was some stickiness, particularly in the services inflation.
Yeah, so what jumped out at you from obviously inflation as a composite basket of numbers? Anything there that sort of caught your attention?
Yeah, so it's really around that services inflation being quite sticky, and just the whole inflation number came in higher than what economists and the RBA had predicted. It was pretty broad-based. Goods prices went back up again. They'd been declining, and services inflation also accelerated over the quarter. And if you kind of look under the hood, there was a lot of government rebates for things like electricity prices, childcare and rents.
Yeah, you spoke about those in the podcast before, so they're sort of artificially dampening.
That's right, and if you back those out, that would have added potentially another 0.5% to the inflation number. So I think the RBA looked at all of that and thought, we have these forecasts saying inflation is going to kind of gradually come down over the next 2 years. And with these numbers being a little higher, they've adjusted those forecasts. So we got a hint to those in the RBA statement yesterday. We'll get the full forecasts on Friday in the quarterly statement on monetary policy. But they basically upgraded the path of inflation. They've added about 0.2% to the inflation track over the next 2 years.
So at each of the future data points, they're foreseeing inflation to be about 0.2% higher than what they previously had.
That's right. So they had it getting to 2.8 at the end of 2025. They're now saying 3.
Right, just sneaking into the top end of
the band. And that's with the latest rate hike. So I think they're just worried. I mean, the RBA's been a reluctant hiker compared to other central banks. They wanted to kind of try and hold on to a lot of the job gains that they've seen over the last few years. And so I think this is an example where maybe they've just been a bit too cautious. Obviously, rates in Australia are still quite a lot lower than some other countries like New Zealand and the UK.
We've been a bit out of step with a lot of the rest of the world, about 1% off, essentially. Yeah. So that gap's probably been too great. And you've talked a lot on the podcast about data dependent. Really, the data was borderline screaming that more needed to be done.
Yeah, I mean, there was a lot of debate in the press leading up to the meeting yesterday where it said, it wasn't material, and okay, yes, inflation was a bit hotter than expected, but, was that material? And I think we got the answer yesterday that it was. Now, where to from here?
Yeah, so you touched on there that we've possibly more to come?
Yeah, I think, markets have got about another 15 basis points priced in by the middle of next year. So, they're saying there's a good chance of another rate hike.
Michelle Bullock not going to cancel Christmas, is she?
No, well, it could be Christmas. There's one bank saying they're going to follow up in December, depending on the monthly inflation data we get this month. And also we get another wages print in the middle of this month. And then there's house prices and things like that, which, she was talked about in the statement yesterday. So, they're very data dependent, and we just have to see. I don't think a December hike is likely.
You'd think, taking the time with the rate hikes they'd already done, and they wanted to see the data flow through. Now they're going to be probably quite gentle on the brake.
Yeah.
Possibly, hopefully, from here to see the impact of each one. But got to be careful of that inflation beast. If it sort of starts to drift back up, it could get an ugly picture.
Yeah, so I think, another bank saying February, that probably seems, there'd be more data will have come out by then. We'll have had, obviously there's a break that RBA don't meet in January. So I think, if there was to be a follow-up, probably February would be the opportune time for that.
Now, we talked a little bit there about Australia being out of step with the rest of the world, and the US in particular. They're sort of been 1% or more above us in terms of their rate hike cycle and got there faster. But we are now starting to see a little bit of a turn in the conversation there, and less of a focus on the rate hikes, and perhaps optimism creeping back in once again. We've been here before. We've had a few false dawns, but on rate cuts and potentially, again, jumping on the optimism of some weak data as it comes through. And last week we saw some weakness in that, or softness in that US labor data.
Yeah, so we've had a few things in the last week that have kind of pulled bond yields back down again. So I think in the last podcast they were kind of up close to that 5% level, and now they're back below 4.6. So, what's driven that? So we had the FOMC meeting last week, and they basically said, well, the rise in bond yields is doing some of the work for us. So if that's sustained, it reduces the need for us to raise rates further.
So let's pause on that one for a second. So the rising bond yields, increases the cost of capital across the whole economy.
Yeah.
Therefore, that has a handbrake effect on the economy. Therefore, the Fed needs to do less in terms of short rates. But then, as a response to that, bond yields come back down.
Yeah.
Are we in a circular pattern here?
Yeah, a little bit. I mean, Powell did say if they were sustained, and he talked about at the margin. So he wasn't saying definitely if bond yields, stay this high, they're doing the work for us. So he did certainly caveat that. And he also said if the bond yields were higher, not because of expectations of the Fed actually doing something. So once again, it was heavily caveated. But I think that the market did take that on board. He also said that a period of above-trend growth would be fine, and he noted that the labour market was expanding, and so that could explain why US growth has been strong recently because of people re-entering the workforce and immigration.
Yeah.
So that was also taken well by markets thinking, okay, they're not going to respond just because GDP growth's running kind of higher than kind of long-term
sort of
trend.
a pragmatic approach.
So that helped. And then, as you said, the non-farm payrolls data came out on Friday night. That was below expectations, 150,000 jobs, which is basically the number of jobs needed each month to ensure unemployment doesn't rise, because that just absorbing the expanding of the labour market and population. And then there were downward revisions of 100,000 to prior months. So all up, and that pushed the unemployment rate up from 3.8 to 3.9. So that was just evidence of that labour market kind of gradually coming back into balance. So I think the market liked that as well. And that's why I've seen bond yields kind of come off and
a bit of optimism in terms of cuts.
And move to price in almost 100 basis points of cuts over 2024.
Right.
So we've done a bit of a round trip. There were cuts there, and then they got reversed higher for longer, and now the cuts have come back
100
in.
basis points, that's material.
Well, it's actually 90, but it's
it's
material. It's 4 rate cuts. So I think that's, and of course the bond market's like that. Bond prices have risen. And the equity market loved it. So we had the strongest rise in US equities since November 2022. Strongest weekly rise, up 6%, I think, for the NASDAQ. Yeah.
And that's sort of undone some of the weakness that we'd seen in October.
Yeah.
Maybe take a moment also to factor in our discussions with clients. We often get questions regarding the geopolitical situation. Obviously, we've had the Ukraine war, unfortunately, continuing on for coming up on 2 years in a number of months, and now the increase in tensions in the Middle East as a result of the unfortunate situation in Israel and Gaza. How much of an influence, or how do you factor that into your thinking in terms of risks, in particular, for a portfolio?
Yeah, I don't. These are things that are very difficult to factor in and manage. The evidence is that markets tend to largely ignore these things. I mean, generally what we have, is a little bit of softness when these things kind of first emerge. And if you go back and look at, World War I, World War II and Vietnam War and things, there was a little bit of weakness, and then kind of people moved on.
They can have quite a dramatic impact on certain commodities that are intensive for the war effort. But
absolutely. So I think we don't really factor it in, just because the data suggests that it doesn't necessarily have a long-lasting impact on financial markets. Ultimately, it's earnings and things like that, and interest rates that drive things. And so, unless it, is a world war or something like that, then probably not.
Or a major sanctions event. Obviously, if we were talking something happening such as China, Taiwan, then that's a fundamentally different situation.
Oh, absolutely. So, but it does, obviously can have an impact on, demand for safe haven assets like the Swiss franc, gold, the US dollar. So we've seen a little bit of that. That tends to be fairly short-lived. It can have an impact on oil prices. I think I might have discussed this before. If the war in the Middle East expanded to Iran and the US was maybe pulled in, then you could see an impact on oil prices. But oil prices have actually fallen. So that's interesting.
You see sort of continued war essentially in the Middle East and the oil price to fall against that backdrop, which probably is a pretty good bellwether in terms of how the markets are seeing the risks on that.
Yeah. And I think, obviously we're going into a US election year, so we'll probably get clients asking about that and what that might mean. And once again, generally does not have a big impact on...
You're not sitting up all night to follow the Trump trial?
No. I mean, I do follow it.
Purely for entertainment purposes.
For entertainment purposes, yes. But
an unfortunate soap opera.
But generally, it makes no difference which party wins, and generally you get a bit of a relief rally after the November elections when they know who the
you've got certainty,
exactly,
the regime and what the makeup is across the houses and stuff. Yeah. Now, the last time we spoke, we were sort of early to midway through U.S. reporting season. Any update in terms of that? Anything caught your attention? Anything material?
No, it was another good one.
Well, I guess that's interesting in itself when we talk about the rate rises that we've had and this wait for the impact of rates, and still corporate earnings still seem to be robust.
Yeah, so corporate earnings, they troughed in sort of year-on-year growth terms in the second quarter. So we've seen them rebound this quarter compared to the same quarter last year. They're up 5%, which is not bad. And if you remove the impact of energy and energy stocks in that, they're actually up 10%.
Right. So
that's a pretty good annual growth rate. 80% of companies, roughly, had beaten earnings estimates. And, that's above the long-term average of around 2/3 of companies beating estimates. So it was another good earnings season. I think... while there were some good headline numbers, there were some misses as well. The Magnificent Seven generally had good numbers, but then people latched on to, for example, Alphabet's cloud revenue not being quite as good as they would have hoped.
As a sort of blunt measure for how their AI rollout is going.
Yeah, so there were a few sort of hits and misses there. And I think also the guidance that companies were talking about, the upcoming quarter, they're a bit more cautious. I think, they're still worried about growth slowdown and the lagged effect of higher interest rates and things like that. So they're pretty cautious in their outlook.
Which is probably what you want to see.
Yeah.
But, certainly no sign. Again, we talk about the narrow path to the soft landing. That would be another reinforcing point that, they seem to be gliding in reasonably well, considering the headwind of normal interest rates again.
That's right. So, as I wrote in the monthly, which we've just sent out, the picture for corporate earnings is pretty good. They're expected to grow about 10% next year. And if we get some of those interest rate cuts, particularly in the back end of 2024, it could be a good environment for equities under that scenario.
Very good. Now, we've talked a few times on the podcast about the AI and AI's impact on certain specific stocks, and the Magnificent Seven in particular. There's one other theme, and I know you're not a big thematic investor, but there's one other area that's catching a lot of attention and dividing the outlook for certain companies based on what side of the fence they sit on, and that is these GLP-1 drugs. Do you want to explain for the listeners just what's happening there and the positive and or negative impact it's having, knock-on impact it's having on across sectors such as biotech, pharma, medical devices, even fast food.
Yeah, so this is a class of drugs, and don't ask me to explain what GLP-1
the science
is short for. It's a type of peptide. It's an it was originally developed as a for diabetes. Yes, that's right. Sorry, and they discovered it had side effects of significant weight loss. And so now it's this kind
wonder
of wonder drug, anti-obesity wonder drug. Yeah. And they're actually looking at what else it could potentially do. So. A lot of celebrities have gone out and started, promoting the fact they lost all this weight and have, which is probably not necessarily what it's designed for. But
isn't that the medical approval process working on its best? Celebrity endorsements.
Absolutely. And there are some side effects. There was a 60 Minutes. I don't know if you caught that, but, of some side effects, and a lady actually died as a result of one of those. So it's maybe not a wonder drug, but... it's captured the imagination of stock investors, and we joke that potentially airlines will use less fuel because their passengers will weigh less, as a result of this.
That's a good example of how people are sort of extrapolating the potential impact of this to quite a degree.
Absolutely, and even in the reporting season, there were some consumer companies saying they noticed, for example, people buying less. Sweet foods and confectionery, or their shopping basket was smaller as a result of this, which they blamed on the GLP-1 drug. So it's caught a lot of attention, and particularly in Australia, some of the heavyweight stocks in the healthcare sector, like Resmed and CSL, have been caught up in it. People saying, "Oh well, sleep apnea, people won't need those devices because they'll weigh less," and that's
less likely triggers.
Less likely trigger, and CSL has a kidney treatment, and that people won't need that because obesity is one of the causes of kidney disease, and anyway, so it's caught a lot of stocks in that whole healthcare sector.
It's kind of like at that early stage, almost like AI in a way, where the range of potential outcomes is so broad that people are extrapolating it, probably over-extrapolating it to quite a degree, but it's certainly one to keep an eye on in terms of how that plays out.
And Novo Nordisk, which is I think it's a Danish company, is now the most valuable company in Europe. It has one of these drugs, as does Eli Lilly in the US. So they've really gone on a tear, those companies. So it's still early days, like AI. It remains to be seen, what impact it has and whether the hype is justified.
All right, please consult your medical professional. Do not consider this a celebrity endorsement by Nick Ryder. Thank you very much as always, Nick, and thank you to all our listeners. Take care.
Take care.